Hey traders, welcome to this fifth installment of the Forex trading series. And in this one, we're going to be discussing Fibonacci, in particular, two of the tools that many of you are familiar with that we're going to utilize. One is the Fibonacci Retracement tool. The other one is the Fibonacci Expansion tool. I'm just going to quickly draw them in, not in any particular place. So that there is the Fibonacci Retracement tool. And what we're going to use this for really is to decipher or just make predictions of resistance or support areas within the present move of the market, which will give us a focal point as to where we might possibly be looking for an entry, right? And once we've utilized some of the analysis, the tools combined, we'll then go into utilizing another tool, which is the Fibonacci Expansion tool, to determine where we think the market is going to project out to. So say for instance we've done our predictions and say this has been analyzed properly, and then we'll just say, okay, this market's going to move out to such and such point up here somewhere before it retraces, right? Now when you're looking at this, you can see market went up there, bounced off there, and retraced back. I'm going to explain that a little bit more in detail soon. And for you, Derek, mate, I'm going to use the word bigly. We're going to discuss this bigly, thanks to Mr. Trump. Now, the thing with what we've come up with so far is this, understanding. What I'm trying to give you guys at this present moment is an understanding of the overall scope to a point that when you're looking at your charts, it's making so much more sense, right? So far, we've looked at the overall scope of the industry, the sandpit within which we operate. We've looked at the various types of brokers, the unregulated nature of the overall markets, and how the Forex market is really just a network of liquidity providers. And now for retail traders, we've got a whole heap of brokers that connect us to various liquidity providers. And so we can actually take part within this $5 trillion industry. And so then also the role you play and the importance of ensuring that your broker that you're dealing with is regulated and that you have some degree of recourse if something does go wrong. So a third party that you can go to and complain to and whine to about whatever issues you're having with the broker, and with the hope that there's going to be enough recourse available for you to be able to get whatever your seed capital is out, right? The next video that we did was about mindset and the importance of understanding who you are, what you are vibrationally speaking, and what actually manifests your life the way it does right now, how all of that impacts on your trading abilities at this present moment and also your trading results, and also understanding like various energies that are at play in relation to just how you function automatically, unconsciously speaking. Then also the different tiers of your mind and brainwave states that you can kind of tap into and be able to manifest whatever it is that you desire. And more importantly, I think we came away with this whole concept of like a millimeter shift in focus, which can result in all of the desires, wants, everything that you kind of want in life, making the whole process of achievement so much easier. My personal favorite of that video and a message that I'd like to get across to all of you is that this whole idea of your immediate past actually goes and creates your immediate present, which actually then goes and creates your immediate future. When you can kind of understand just those three moments and the relationship that they have to each other, you'll be in a position where you know that at every given moment you have full control to establish a new future for yourself. And that's where I'm challenging you guys to say, let go of everything that you've known in the past, embrace this newfound awareness that you have, and go create those new future moments filled with everything that you desire and very little of everything that you would not want in life, right? In regards to that word desire, it's nice to want and need and have all of that sort of stuff, but just don't be attached to it, okay? Because attachment will create fear. Fear of loss, fear of not being able to achieve, fear of failure, all of that sort of stuff. It's human nature. And then energetically, you've got projections happening from around you, right? So it's extremely important for those of you that haven't touched upon this to kind of revisit that and be able to recreate a new, more powerful version of yourself. Just awareness alone is enough for you to achieve that. In the next video, we touched upon the stadium. So we looked at the overall picture, and now we're breaking it down into where you're actually going to play the game, who you're playing against, how you're going to look at currency pairs and understand that there's economies that are kind of coming together and weighing up against each other. All of this stuff up here within our platforms, these are our tools that we're going to utilize to be able to make some certain decisions as to where we think the market's going. And then we finished off with an objective. The objective for new and experienced traders alike is basically this, that we're looking for previous price movements. And how do we do it? We're simply just looking for these places here, these lows and these highs. Let the market do whatever it's meant to do, and for it to actually create its movements back, forth, back, forth, back, forth, that sort of stuff, right? Yes, that was wrong. This was forth, back, but you know what I'm talking about. So what we're looking at is previous lows and previous highs and vice versa. Once we have that, we've got like a mountain range that's happening, right? So in order for you to decipher the height of a mountain in particular, you've got to know that it stopped growing. It stopped growing for just that piece there. And once it stopped, we can then go ahead and now measure it. But if it's still kind of climbing, then there's no real way of measuring it, because by the time you do a measurement, it's going to climb some more, right? So what we do is we let this thing this mountain range create itself. And once it has established its base, and then it goes up and establishes a peak and starts to revert back, that's when we can start utilizing certain tools and say, okay, I now know where the market has been. Now what I'm trying to figure out is where the market actually presently is in relation to where it's been, and utilizing those two pieces of information, I can safely project where the market is about to go. And that's all we're doing. That's the objective. So if I was to look at where the market's been, market's gone up, come back down to a point which is higher than here, right? You don't have to understand higher highs and lower lows and all of that sort of stuff. Just look at a point like we're half brain dead or something. Here's a pretty picture. I'm seeing reds and blues and grays all over the place, and what to me looks like just black squiggly lines all over the place. And here's a point where the market did a sharp poke at the bottom. Here's another poke. It's like poking someone's eye out at the top, and then it's coming back. So we're looking at that and we're thinking, okay, where do I think this market's going to come back to? Because remember, at any given point, it's still doing its squiggly thing. So we're looking at this one macro level overall picture, and then we're saying we're trying to predict overall where the market's going. At this point, we're not even considering an entry. We're just trying to figure out, in relation to price, where the hell is this thing headed? So this is where we start utilizing our Fibonacci retracement and expansion tools. So for those of you new traders using MT4, this squiggly line with an F thing here, you click on that, and if we're going to measure going from a low to a high, I'm going to place the 100% line at the bottom, and the reason for that is that I'm trying to figure out how far this market's going to come back to in relation to this move here. Okay? In order for us to establish a retracement, we're going to always look at a previous move that's already happened. So we're going to say now this is our 100% line, and for those of you that understand candlestick patterns, it's basically like this is an outside bar, and we've got a whole heap of inside bars, and we're kind of just trying to figure out how far is this inside bar going to come back down to in relation to the distance or the height of this outside bar. So I'm going to press and hold there, and then drag this all the way up till just the tip of that poke there, and then I'm going to look across to the right and see how far this market is actually going to revert to. Now, we've got some key areas that we already know in regards to Fibonacci where the market tends to kind of bounce off. We've got, first of all, our 38.2. It's a semi-important line or area, and our personal favorite is the 618, right? So for some reason I've got a line already drawn in here. So this is where we'll say, and say for instance price is somewhere here and it's still breaking down, this is where we'll say, okay, this is an area of key focus for us. And in our minds, this is where we'll start to think about where price is in relation to session. because part of our criteria will say the market tends to move more so at the open of sessions, in particular open of London, open of New York, right? Two best times for us to be trading. So what we're going to do is we're going to look for an entry at the open of London or open of New York, and we're going to say, okay, price is going to come back to this point. Doesn't necessarily mean that as soon as price comes here and you take a trade immediately. For a lot of traders that kind of put pending orders in place, this is where you guys mess up, because for a lot of people it'll be like, okay, I'm expecting price to come back down here. I'm going to put a pending order somewhere here, either above or below that 618 line, right? And then what they'll find is the market comes back and does a low, and they would have been out of the money by a certain number of pips and most likely even been stopped out, and they're scratching their heads thinking, okay, why did the market go reverse? Well, Shiva told me it's going to bounce off the 618, right? We don't take those entries straight off. We're now observing. We've also got this cross of the 50 and the 200, so we're kind of just observing as to what price is doing. Our prediction is that in relation to this move here, price is most likely going to bounce off 382, or it's going to bounce off the 618. In this case, it does break past our 618 and comes all the way down and does a poke to the low at the open of London session the next day at our 786. This still is largely irrelevant to us. So the market then pushes back up, and this is where we start to pay attention. Remember, all of this here combined over the course of this 24-hour period, so pretty much almost like 1.5 days almost, is where you've got this bounce happening at the next open of the New York session, where market is giving us a bit of a false move, pushed down on the 618 line before it pushes up. This is a focal area for us. This is where we're now using our 2 minutes of, a span of concentration or something along those lines, or that 30 seconds of span of concentration, that we're going to now open our eyes up and say, okay, price is going to behave a certain way. This is where we're looking at candlestick patterns. This is where we're looking at market patterns or chart patterns. You know, your double tops, your double bottoms, all of that sort of stuff. This is where we're looking at price, how they behave around the 50 or the 200 before this starts to head up. And in this case, look at it. With our confluence of events, the market just bounces off significantly. Now, if we've missed that, it doesn't matter. Like for me, I don't trade New York session because I'm asleep around that time, right? So if I've missed this, I will come back the next Asian session and now know that this analysis that I've done is accurate. This market is moving in this direction, right? Where would I look for entries? Again, my confluence points. Maybe a bounce off the 50. Here's the 50-200 crossing, right? Bounce off the 50, next session. When? Look at that. London open, New York open. Two opportunities. That possibly would be about 20 pips there. This would be way more than 20 pips there, right? Those are two opportunities that you have to take your entry. Now, let's say, for instance, we've done, okay, before I get rid of this, we've done our analysis to say this is where the market's retraced to. It's bounced off some key areas that we are familiar with, which is the 618, memorize that, and the market's starting to head up now. So how do we predict where we think the market's going to eventually head to? And that's where the expansion tool comes in handy. So we'll go into Insert, Fibonacci, and then Expansion. And like previously, where I was utilizing the retracement tool, and I had the 100% line down here because I wanted to see how far it actually retraces to. This time around, 0 is going to be here, so I'm going to hold this down here and then expand out and see where my 100% line is. I'm going to go and hold that to the tip of this bit here again. See 100% here? This would be the tip again. And the reason for that is, like previously, we did analysis of where price would revert to from our initial low and initial high. So this was the initial move we wanted to utilize to measure for the market doing a bounce back. We're going to utilize the exact same move to now project where the market's going to go. So this whole entire area here is largely irrelevant to us. We kind of wanted to know that this market is going to bounce off a critical juncture, right? And you can, and for advanced traders, you can still trade all of this, guys. You can still trade it. But what we're doing is we're trying to project a future moment where we think the market's most likely going to head to. And this is where the Fibonacci expansion tool comes in handy. So when we draw this in from this point to this point, with a 100% line being there, and you pay no attention to the 618 line over here, that we can now say there's every chance that this price is going to project out to the bare minimum, the 127 line, and there's a very highly likely chance that this whole entire thing is going to project all the way out to our Fibonacci golden ratio, which is the 1618 line, right, which is up here. And so if you were to take an entry at any point in time after here, or even past that 100% line, this bounce off here, up to 127, that's 22 pips, so you would have hit your 20 pip mark. But if you were to go all the way up to the 1618 line, then we've got easily 57 pips. And for those of you who are new traders, if you look at just that middle area, see how that's right now it's 601. If you come in 1 decimal point, that means 60 pips that you would have made, right? But for our extension purposes, we're still riding the 20 pip waves. Okay, so that's where you can project out to say price most likely will get to 1618, right? Now, in regards to reset, retest, price rejection, we can also use this 1618 line to say, okay, when price hits this mark, we're expecting that price to revert back down again. So what we're looking for again is a point where market's going to hit multiples of times and then come back down again. So in this case, if we zoom back in, this is what the market was doing. This is what the market had done. It hit this point, 1618, came back, consolidated through the Asian session, hit it again, and then went back up, broke it, and created an M formation, double top formation, before it started to come back down again, right? I actually took a trade using this analysis, but I did it on the Euro JPY pair yesterday and hit about 30 pips. Now, the thing with that is this, and I'm going to discuss this in a later video, which is going to go over correlation disparity and cancellation of currency pairs, and that's just looking at the relative strengths and weaknesses of currency pairs to choose whether you'd like to take a trade in one currency pair or another. Okay, and for me personally, it's like whichever one's going to move quicker and with more strength, I'd like to go with that one, right? So if you were to take a trade off that one, this one in particular, you would have entered there, and that's 20 pips for you in 45 minutes. That's how we're doing it. That's all we're doing. And this, in short, guys, is how we utilize this Fibonacci expansion and retracement tools, right? Now, like with everything else that I'm trying to do with this video series, is that I want you guys to have more of an in-depth understanding as to why we use the tools we use. So in the previous video, we discussed moving averages and how the calculation actually happens for that. In this video, we've spoken about Fibonacci, but let's have a bit of a discussion in regards to the background of Fibonacci, because once you start to understand the importance of it, in particular, why did we utilize the 618 as being important as opposed to all the rest? Because these still are Fibonacci lines, but of importance for us, which are the golden ratios. The 618, which is the inverse of the actual golden ratio, 1618, right? So why is it that? And what's so important about it, and why should we always pay attention to it? So let's have a bit of a chat about it. Where did this whole Fibonacci sequence come from? It basically existed back in the 5th century or so. I think it was the Indians or the Greeks. One or the other actually did discover this, but it wasn't until the 12th century when Leonardo Bonacci, an Italian mathematician, took it out to the West to reveal a unique number sequence. Okay, and basically what he discovered was that, I've got this written out somewhere, that if you were to start with like binary codes, so 0 or 1, and then followed by another 1, what you could do is create the next number by adding the two former numbers, right? So the results would actually have been that this number here is the sum of the two previous numbers. So and then we'll follow suit. This number here, the next one will be the sum of these two numbers. This number here will be the sum of these two previous numbers. This one, these two previous, this one, these two previous, and this one, these two previous. And this could just extend out all the way to infinity. And that's what they discovered. Further observation actually found another unique relationship that these numbers actually had. And that's where the birth of the golden ratio came from. And basically what it was to say that this number here was exactly 1.618 times this number here, right? And once you got to this, the seventh number, which is the 13 in this sequence, that from that point on, all the subsequent numbers were actually 1.618 times the previous number. And that's when they started discovering that, you could just continue this going into infinity. So in this case, the next number here within the sequence would have been 21 plus 13. That would have been 34, right? So if we got a calculator here, and we wanted to work out that what ratio of this number here actually is this number. So we'll say, okay, 21 times 1.618 equals 33.978, right? Now, the golden ratio, which is the Fibonacci number 1.618, that actually extends out to 15 decimal points. So if we actually had the 15 decimal points, that would come out to give us 34. Right now, just with 3 decimal points, we've got 33.978, right? The inverse of that is also accurate. Now, so you're familiar with 1.618 as to why that was of importance, because as you see the frequencies, the sequence increasing, there is that unique relationship between the previous number and the next number. But in the same way, if you worked backwards, what you're also going to see is that this number, or this number is exactly 0.618 of this number. Okay, so I'm confusing myself. Let's go back to the calculator. So if we were to take 34 and then multiply that by 0.618, we should get something close to 21, right? So here's where we start to realize the unique relationship going forward and coming backwards with the two numbers like that are sitting ahead and after each other. And that just continues out going into infinity, right? So that was the discovery. And then further observations actually found that if we were to break down the universe and creation itself into unique formulas, what we're going to discover, and we were then to calculate those formulas, what you would discuss is what you would discover is the results will then end up showing us this exact ratio, the golden ratio, which is the 1.168. That relationship would exist within the results of all the calculations that would happen. And further on, they actually did discover that not only in mathematics but sacred geometry, proportions in terms of the human body, in terms of animals' bodies, in terms of plants and DNA and the solar system and music and art and architecture and stuff, and even like the stock market and, for our benefit, the Forex market, that if you were to look at the unique relationship between, or the mathematical relationship between results that are forming, what you'd find is that within that, the observation would be that this golden ratio will manifest itself in some way, shape, or form. I think it was Galileo that, I think it was Galileo that actually once said that mathematics is the alphabet in which God has written the universe, right? And he's correct. If you look around us with everything that's manifest for us, that in some way, shape, or form, like physicists, will be able to break that down into mathematical formula to be able to say such and such equals such and such, right? And if we then accept that if these formulas were broken down and then results were, they were calculated and then results were tallied and then the results themselves were compared to each other and analyzed, the unique ratio, the golden ratio, will manifest itself, right? And then it comes back to this point that I mentioned in the second video, the mindset video, of the immediate past creates an impact on your immediate present, which creates an impact on your immediate future, right? If we were to somehow calculate and break that down into mathematical formulae, I'd be pretty certain that the unique relationship going back and forth would actually mean we're going to discover the golden ratios, which is the 1.618 and the 618. And that, in short, guys, this is what we actually need to know. That's all we need to know, that within nature itself and within the universe itself, something happens around these golden ratios. This establishes a unique bond and a relationship with just 2 points. Okay? And if that relationship exists, we don't really need to understand it too much. But if that relationship exists, we should be able to see evidence of it. And that's what we're seeing continually within our charts daily. Doesn't matter which time frame you look for it in, it does exist. And so that's why we're utilizing these Fibonacci lines. Okay, simply put, all we're doing is we're establishing a 100% move. Okay, so from one point to another point, and then we're measuring the retracement, the move back from our initial high and our low, or initial low and our high. We're measuring the move back in proportion to this initial move. So that's why we're saying part of our objective is to look at where the market's already moved, and then utilize this magic that happens within the universe, this Fibonacci sequence and the ratios that come of it, to be able to then figure out where price is at the very moment in relation to the initial previous move that's already happened. And when we look at that, we say there are certain areas within the whole Fibonacci sequence and ratios where the market just behaves a certain way. And in this case, 618 and 1.618, the golden ratio, the unique relationship. So if you can kind of accept that in your mind, that there is this unique relationship that's existing around us right now, and this ratio of 1.618 actually plays a major role in the relationship of the building blocks of everything, like, we're literally making sense of it, you can actually do something with it trading wise. Now, for those of you that want to know what this is called, Phi, which is, I believe, it's a Greek letter, the 20th or the 21st Greek letter or something along those lines, and it's spelled PHI. So you guys can do more research on this if you wanted to, just Google it. And there are books that have been written on it, but what I've actually mentioned in this video pretty much is all you need to know. And in short, again, what we're trying to decipher is where the market's going to come back and bounce off, retrace off, or where price rejection may happen. And then we're using the expansion, which is going to expand out to the golden ratio for us, to see where the market may actually get to. And then once it gets to that point, is it going to then reject off there and climb back again, as it did with this here. Okay, so I think that is it. The last thing that I'd want to talk about, if I can just get rid of this and draw you a very ugly picture, in relation to Phi and in relation to the Fibonacci stuff, is that if you were to draw a line, right? In short, this is what we're trying to understand. If you were to draw a line and then break this line into two segments, okay, it doesn't have to be equal. What you're going to find is that if you were to divide the longer piece by the smaller piece, the ratio that you will get will be equal to dividing the longer piece, the overall line by the longer piece. So this divided by this would equal to this divided by this, and that will establish itself as a ratio. And what you'd find in most instances, it doesn't matter how you play around with this line, wherever you break it, the ratio that you most likely will come up with is 1.618. Okay, we're not physicists, and in normal human language for us, all we need to know is that something happens around those lines, and that's where our eyes open up, and that's where our attention span, whatever limited attention span we have, whether it's 30 seconds or 2 minutes, that's where we apply it. And we say, okay, this is a focal point for us, and we're going to start paying attention to it. Okay? In the video, when we're doing Elliott waves, this information in regards to Fibonacci will come in handy, because once we get to the Elliott waves video, what you're going to be seeing is how all of this, everything from moving averages to Fibonacci to why the market moves in waves to the different types of waves that are happening, to support and resistance, to candlestick patterns, in particular chart patterns, M&Ws, all of that sort of stuff. Like, where would you apply that? And where would that actually make sense to you, and how you can kind of project out to a certain point of, you know, how many pips you can collect and all of that sort of stuff. Now, I think I better shut up. I don't want to confuse you guys too much. I believe that is it for Fibonacci. Please do ask me any questions that you have in the comment section. Okay, and then we'll go from there. Next videos will be up soon. Bye, guys.